Welcome everyone, thanks for joining. In this video, we do have a lot to go over. We have the whole Peloton issue with them doing a major recall. I've been bullish on Peloton, so I'm going to be sharing my thoughts on this, what I'm doing with my holding, and everything related to that story. We also have different changes I'm making to the story funds. So this is my aggressive growth-centered portfolio. It's struggling right now as we see a big sell-off in the smaller hyper-growth tech companies. A lot of these hyped-up companies, they're not doing so good right now. So I'll be talking about that as well. But before we jump into all of those specifics about this portfolio, I want to first talk a little bit about 2020 and how unique 2020 was. Simply put, a lot of things that worked in the stock market in 2020 are no longer working. They're not working in 2021. And people have different thoughts about this. Do we just continue on doing the same thing that worked in 2020? Do we readjust and realign for 2021? What do we do with our portfolios? There's a lot of conflicting viewpoints. There's a lot of people that have different opinions on what direction to take it. But first, before going into what I'm going to be doing with my portfolio, I want to just explain why 2020 was so unique. Now, I know you're thinking, duh, Joseph, 2020 was unique. We had a global pandemic. None of us have experienced that in our lifetime, where we've had to shut down the economy, quarantine in a house or wherever you are, and then wear a mask wherever we go and wait for a vaccine and get a lot of stimulus money and government support in the meantime. None of us have experienced that before. It's completely unique. I've never had a time in my life where I thought we might actually run out of toilet paper for good. Like that might not be a thing in our house, right? Luckily, I bought some toilet paper and put it in the storage room before the crowds of people went to Costco and bought it all out. So that was unique. There was nothing like that in my life that I've ever experienced before, and hopefully never again. But 2020 was not just unique in real life. It wasn't just unique going about your business and work in general. It was incredibly unique in the stock market. And a lot of people started investing in 2020. So they don't have any prior experience to give context and to give comparison to 2020. And 2020 wasn't just like a normal sell-off or a little bear market that we recovered from. It wasn't just like that. It was more unique than that. The events that happened in 2020 in the stock market are incredibly unique, and it's highlighted in this post here. This is a blog post from Ben Carlson, great last name, but no relation there. And he has a post called How to Lose Money When the Stock Market is at an All-Time High. I want to read just a couple parts of this where he goes through and highlights how unique 2020 was. He says, from the bottom in late March of last year, the US stock market was up nearly 75%. So if you had timed the purchase perfectly at the bottom of the market in March, which of course is next to impossible to do. I don't know anybody that timed it that perfectly. But if you had, you would be up 75% just investing in the US stock market, not picking out any individual stocks. He says this was the best 12-month return ever recorded since 1950. Not since 2007, not since the 2000 dot-com bubble, not since the 1970s lost decade or hyperinflation, since 1950. That was the last time we've ever had a fall that big with a recovery this quickly. A 12-month return of 75%. That's incredible. So this isn't just like your average every 6 or 7 years, a little bit of a market sell-off. This was incredibly unique. He goes on to say that nearly 96% of stocks in the overall US stock market showed a positive return in that time. A way that you can measure that is by the 200-day moving average. 96% of stocks were above their 200-day moving average, meaning that you could pick out almost any stock, and if you had invested in it during the lows of March, you would have a positive return in 96 out of 100 stocks. That created a unique situation as well. Stock pickers, people that pick these hyper growth stocks, the small technology ones, all the hype stocks on YouTube, all those type of ones, there was a 96% chance that those were going to be in the green. So as a stock picker's paradise at this point, a stock picker's dream, you could pick out almost any company and have a good return on it. He says it's highly likely we will never experience a 12-month period of returns like that again in our lifetimes. So it's not impossible. We could have another crash that the market falls this fast and then it recovers as fast, but it's unlikely. Based off of the historical data, this is a once-in-a-lifetime event. That's how unique it is. He says, if you think this type of market is normal, you're sorely mistaken. It's not always going to be this easy. And that is the point here. That's what a lot of people are finding out. A lot of people were new to the market in 2020. They downloaded the Robinhood app. For whatever reason, it blew up on social media and different investing in general for millennials and Gen Z blew up on social media. So millions of new investors entered the market. And a lot of them found that one style of investing was very boring and didn't give the greatest returns. And another style of investing was like free money. The style of investing that really worked in 2020 was the more speculative, the more high risk stocks you went into, the smaller, more volatile market cap companies are the ones that performed well. It didn't matter how good the companies were. It didn't matter if those companies made money. It didn't matter if those companies were profitable or had stable businesses. Some of the companies actually have no revenue. Some of the companies were SPACs. They were pre-revenue. They were literally just stories. They hadn't proven themselves at all, but they went up 20 and 30%, while stable companies like Home Depot or Costco just made their little marginal incremental gains, right? They just went up step by step. But the style of investing that was very popular in 2020 was the high growth, extremely aggressive, high risk strategy of avoiding the big companies, the large market cap ones, and investing in anything that has a lot of hype surrounding it. Anything that's smaller, that has a good story around it. Those were the exciting type of stocks that did well. And now we're starting to see a reversal of that. That type of thing has kind of transitioned to where now the boring companies, the dividend payers, the incremental growers, they're outperforming, and the ones that used to be the kings, right? These more speculative stocks, these are the ones getting crushed. We can look at an example of this. We have the Invesco QQQ. This is more of the tech-heavy type of stocks. This is up 6.5% year to date. So it's in the green. This isn't an index of the really small, speculative, really risky stocks, but it is more technology focused. It's in the green right now by 6.5%. But look at the S&P 500. Year to date, the S&P 500 is up 14.5%. It's over doubled the returns in 2021 of the QQQ. So SPY, the most boring thing ever that Warren Buffett tells you to buy, just the 500 biggest companies in the United States, market cap weighted. It's super simple. It's outperforming the QQQ by over double year to date. That's how good the S&P 500 is. But then we can even go another level. We have the Schwab U.S. Dividend Equity ETF. A lot of those companies that people hated, the oil companies, the boring utility companies, the industrials, a lot of the companies that have a large amount of debt, they're not exciting startup growth companies. This is up 23% year to date. 23%, while the QQQ, all the technology companies, are up 6%. So the dividend companies right now are crushing the rest of the market. The more boring and less speculative the company is, the better it seems to be doing. And then you have the polar opposite of the Schwab US Dividend Equity ETF. You have the ARK Innovation Fund, right? The ARK Innovation ETF, this is their flagship one. It's currently down 15% year to date. Now, of course, we have the year view and it's up doing really well. But investors that are buying this recently a lot of them bought it right here towards the top. You can look at the inflows to this fund and the amount of new investors, and many of them caught on and started buying early in 2021, believing that these type of stocks would just continue to perform like they have throughout the past year. They saw the graphs, they saw the outperformance of the ARK ETF, and they thought, why should I bother investing in a broadly diversified a more traditional ETF when we have the ARK Innovation Fund that has crushed those over the past year? Well, like we're seeing this type of thing where the same stocks just seem to outperform for a prolonged period of time, it does eventually come to an end. And that's what we're seeing with the ARK Innovation ETF. It's starting to go down a little bit. It's down 30% over the past 3 months. Year to date, it's down 15%. And that's at a time where the S&P 500 is up almost 15%. And where the really non-speculative companies, the ones that have paid dividends and they're more mature, are up 23%. So what is the takeaway from this? There's a lot of takeaways and a lot of different opinions. A lot of people are going different routes. My takeaway is that valuations do matter. They mattered in 2020, even though the valuation sensitive investor was not rewarded. In 2021, if you were investing based off of valuations, you were not rewarded as an investor. The people that just bought any company and said valuations don't really matter. It's all about the future. It's all about the story. It's all about the company. Doesn't matter. Any price is good. Right now, they're in a tough spot right now. They're finding out that valuations do eventually matter. If they don't today, they will tomorrow. So that's one takeaway, is that valuations matter. The next important takeaway for me is that diversification matters. It's very important. In fact, I can show you, for example, my portfolio, the Story Fund. This is my growth-centered portfolio. I have another one that's a dividend portfolio. It's doing better than this one, actually. But this is my attempt at creating a more aggressive growth-centered portfolio. So I'm trying to beat the S&P 500. Right now, it's not going so good. I'm behind, right? I'm still in the green. I'm up about 11.5%, but the S&P 500 is up 18.48% because SPY is doing really well. It's performing really well right now. Well, regardless, my portfolio, even though it's behind the S&P 500 currently, it could be doing a lot worse if I wasn't as diversified as I've made this portfolio. For example, we have some companies in this portfolio that fit in that category of the hyped stocks of the past year. Companies like Spotify. This is one of my favorite products. I love Spotify. I use it every single day. I want to be a shareholder of this company. I view my ownership of Spotify in the way that Warren Buffett says to view investing, where I literally feel like I'm part owner of this company. I want a piece of it. I think it has a great future. And despite the fact that I think it's a great company, the momentum investors and the big hedge funds have moved out of this company, causing the price to come down quite a bit. In fact, I'm in the red, $1,600, and my current value is $5,000. So this company so far, in my profit and loss, it's definitely been a loss. Right now, on paper, it's a loss. But again, this is a long-term holding. I really like the company. I remain bullish on it. If we look at some other companies that are even more speculative, in my opinion, than Spotify, we're seeing trouble with them. We have Peloton, DoorDash, and Teladoc, which are all in that category of those exciting companies that they did really good in 2020, but they're getting crushed currently. Peloton's down like 45% from their all-time highs. They had a recall on their treadmill that I'll talk about in a minute. DoorDash is a company that is extremely volatile. It trades up like crazy to a $60-70 billion market cap, and then back down to half of that, right? It drops down half in price. And then we have Teladoc, which is another one of these exciting companies, telemedicine, but it has a lot of downward pressure on it right now. So I'm in the red on this one. Now, valuation does matter. With Peloton, I did buy this company when it had a much smaller market cap. So despite the recent huge sell-off, I'm still in the green on it by a decent margin. My average share price for Peloton was $80 a share. And I wasn't buying it when it soared upwards because I thought it was a little bit higher risk. But regardless, I've lost a lot of the gains on paper from this company. So these type of companies have really hurt my profit and loss over the past 3 months. They've traded down like crazy. And that would be bad. I could be in a very bad situation right now where I'd be not making money at all, but currently the portfolio is still in the green. I've not been making a ton of money with it, but it's still in the green. And the reason why is because of diversification. Those aren't the only companies that I own. In fact, I own a lot of different companies. We have Google, which is in the green, $1,700. So that helps balance things out. That's another bigger company, a blue chip one, right? I think Google's a great company that has a really good risk-adjusted return. I've said openly many times that, well, at least a couple months ago, I thought Google was the best growth company in the market, where you have the highest likelihood of making money and the lowest likelihood of losing it over a 5-year period, in my opinion. Now, we also have Netflix. I'm in the red by $1,000 on that one. Then we have Amazon. I'm in the green by $277 on that one, so just a hair. We have Salesforce, a company that I'm very bullish on. I think I'll make money on this one in the long term, but I'm in the red by just a hair, $119. We have Facebook, big company. Everybody knows about it. It's in the green by $665. So it starts to balance out a little bit. Adobe in the green by $114. Apple, this is one that I've recently added. I'm in the green by $270. PayPal, I'm in the green by $154. Disney, I'm in the green by $485. CLTD, I'm in the red by $220. Microsoft, I'm in the green by $79. So on and so forth. You can see the role that diversification plays here. If I only had one type of company, if I only invested in the very small market cap, the sub $100 billion market cap, companies like Peloton, DoorDash, and Teladoc, I probably would be doing a lot worse right now. So that is another big takeaway, is have a diversified portfolio. Even if you want to go for growth companies, diversify within growth companies. Have bigger growing companies like Google, Amazon, Facebook, and Salesforce, and have smaller ones like Peloton, CrowdStrike, Shopify, the smaller market cap ones. But make sure to have some level of diversification because it can save you a lot of grief. If you just focus on one type of company, you can do good for a short amount of time, but eventually diversification does help you in the long run. And the last takeaway from this is that investing is difficult. It's hard. It's tough to be a good investor and pick out individual companies. And in some cases, it's tough to even hold on to an ETF, a broadly diversified ETF, when you see other people making money with individual companies. So it's difficult in both ways. If you're an investor in an index fund like the S&P 500, the difficulty was last year watching all the people making money with all the different cryptos and the SPACs and the hyper-growth tech companies. It was difficult to sit there and be patient while watching people that in the back of your mind, you're thinking, man, they're not even paying attention to risk or valuation and they're doing better than me, right? That's difficult to do. You have to be the one that's patient all the time. And likewise, it's difficult as an individual investor. You can invest in a lot of companies that you're excited about. You can buy companies like Netflix and Spotify that I've highlighted videos showing my enthusiasm for these growing businesses and exciting industries. I see a lot of tailwinds and a lot of opportunity here, but it's difficult to hold on to them when you see your portfolio go into the red and you see that you start to lose money. It makes you second guess your investment thesis on these companies. So it's both difficult to hold index funds in certain situations, and it's difficult to invest in individual companies. Investing is a difficult business. And like Warren Buffett and Peter Lynch have repeatedly said, the investors that make money are the ones that have a good temperament, not the most intelligent ones. The ones that are able to just stay calm, invest in good companies for long term, or hold index funds or good funds in the long term. They're the ones that make money, not the ones that are changing in and out of industry and switching investment styles left and right. The ones that have diversified portfolios that invest in good equities or good funds for a long period of time will make money over time. So when I look at companies like mine that I own that are in the red right now, I look at Netflix. They might be growing a little bit slower now. There's some competition, but I look at the company and I think it's a great company that I want to own for the future. So even if it continues to trade downward for a while, I'm still glad to own this company. I think there's a good chance Netflix will be one of, if not the biggest streaming company in the world 10 years from now. So that's a good opportunity there. I wouldn't make this my only holding. I wouldn't go 100% into Netflix, but I think it's worth a decent portion. And then we have Spotify. This is another company that regardless of investors choosing to sell out of it right now, I think the story is still intact. I think the company's still growing. They're growing their monthly active users. They're growing their premium subscribers. And I love the product and service. So until the actual company starts to change, I'm going to continue to own this business. I don't care if it sells off 70%. If it did, I would buy quite a bit more of it because I think it'd be very cheap if that was the case. But the company continues to progress forward, continues to gain new subscribers, active monthly users, go into new markets. I'm excited about the story of Spotify. It may fail. Over time, the business may fail, but I'll let the business decide whether or not I buy or sell this company, not other investors. We have the more volatile examples. We have Peloton, for instance. This is one that they had to recall their treadmills because they had issues with it. In my opinion, it was pretty poor how they handled this. They basically argued with the authorities saying, we don't need to do a recall. And then they totally did a 180 and said, yeah, we shouldn't have done that. We do need to do a recall and figure out what's wrong with our treadmills, which I think was probably the right thing to do from the beginning. The CEO has apologized, but this has affected Peloton stock along with it being in that category of stocks that are being sold off right now. So Peloton it's been hit both ways. It's been hit because of the recall and it's been hit because it's in that category of stock that's being sold right now. The story with Peloton, in my opinion, hasn't changed. It's still there. The story is the exact same despite the fact that it's sold off recently. In fact, we can look at this graph right here. This is the connected fitness subscribers for Peloton. This is the amount of people that have both bought one of their pieces of hardware and have an active subscription for Peloton quarter over quarter. So every 3 months. Right now, we have over 2 million people that have an ongoing subscription to Peloton. And just last quarter, it was 1.6 million. Does this graph look like the chart of a failing company? A company that's just going out of control, it's declining, and investors should be heading for the exits. Is that the picture painted here? No, it's clearly not. This company continues to grow rapidly. The story hasn't changed with it. What has changed with it is a lot of momentum-based investors, short-term investors, have repositioned their portfolios to focus on a different type of company that they think they can make quicker gains in. That's the story change. And it's the same thing with DoorDash. This is a company that's highly volatile. It's an incredibly highly volatile, in traditional terms, it's a high-risk company because it traded from like a $30 billion market cap valuation, $30 billion, up to 60, even up to 70, and then back to 60, and now it's back to 40. And I made some purchases, I think, in the $60 billion range, which put me in the red right now. So I'm in the red by $543, 33%. So this is one that I'm in the red on paper, and it's a highly volatile, high-risk company. I don't have it as a huge holding in my portfolio, but the story really hasn't changed with DoorDash. It's still growing. It's still expanding. It has lots of potential issues. It has government regulation. That's a potential issue. They're working with restaurants that some of them don't like DoorDash. Some of them do. But what I see is an exciting product that offers convenience. And convenience is something that people highly value. Even though DoorDash is expensive and it has a lot of potential risks, the product offers convenience, which is highly, highly valued. It offers convenience both for the worker that can choose to work anytime they want or anytime they don't want, they don't have to work. So a lot of drivers for DoorDash enjoy that work. They enjoy doing it. I read the forums and most of them really enjoy working for DoorDash. They're grateful to have the opportunity to work for a company where they can just sign in, make some money, sign out anytime they want. And there's no demands by a boss. There's no requirements, right? There's nothing you have to do. You're just doing it completely willingly. So a lot of the drivers like the company and a lot of the customers like the convenience. They order a couple times a week when they don't want to go out of the house. Maybe you're taking care of kids or something. It offers added convenience. And even within the office place, there's some people ordering it for their entire coworkers, right? They might get together and do a group order of DoorDash and enjoy that in the office. So until I see the actual story of the company change, where people no longer like the product, where people aren't buying it anymore, where the company's not growing its revenue, people are canceling their subscriptions, and they're not attracting as many drivers, unless that happens, I'm going to continue investing in DoorDash. The price might fluctuate. In fact, it definitely is going to because this is a high-risk stock, highly volatile. So the price will bounce around. I could go further into the red. I could go further into the green if it starts going back up. But regardless, I'm going to hold on to it for the long term because over the long term, the performance of the actual company will be the bigger determinant of the price. In the short term, it's momentum traders and it's all the big hedge funds that move money in and out. But DoorDash right now, I think, is an exciting company. If it were to trade down to a $30 billion valuation or a 20, I would probably be picking up more shares of the company. Right now, I'm just going to hold it. But if it does trade down more, I'm going to be buying more of this company. And the same thing with Peloton. If Peloton trades below my buy-in price of $80, I'll probably start looking at taking a few buys of it and buying a little bit bigger stake in this company because I still think they're exciting companies and I still think they have a future. So that's what I'm doing with my portfolio. That's how I view this situation. I think all of us knew in the back of our heads that the environment in 2020, with the way that every investment seemed to rocket up, especially the more speculative ones, that wasn't going to last forever. It had to come to an end at some point, and I think that environment is over. And that style of investing in anything and seeing it go up in price is probably coming to an end. Now it's going to be what companies are successful. That's going to be it. If the company is successful over a long period of time, the stock price will follow. If the company is not successful, the stock price will also follow that and you'll lose money over a long period of time. So even though this has been a brutal past couple of months for people that have especially invested heavily into the more speculative side of things, if you have good companies and they have good stories, you have to have more patience. You have to be patient with these companies and see their story play out. And every investor, I think, should have at least a decent amount of money into a broadly diversified portfolio or into an ETF. I think that's a must for everybody. I have the Story Fund, which is one of my portfolios. This is my growth center portfolio, but I also have the passive income account for my other channel, which is very diversified. It's in a lot of blue chip tech companies, a lot of blue chip consumer good companies, and that helps reduce the pain when you have sell-offs like this. So I think diversification is very important. So that's how I view the situation. I'm going to continue to give you updates on the Story Fund, on the performance of it, as well as I have some exciting research into different companies that I'm very bullish on. One of them I'm going to be sharing later this week. So if you want to subscribe to the channel, you'll be able to see that. Other than that, I'll see you guys in the next video.